Right, we might as well get started. Before we continue on with lecture material, I just want to remind everyone that homework 1, so the unit economics problem that I posted a while back on my courses, is due at the end of Friday for this week. So if you guys haven't completed it yet or are struggling on any parts of the problem, please don't hesitate to reach out to me either by email or in my office hour my office hours this Thursday, because I want to be here to help you guys with any struggles you have on that problem. It's a relatively complex problem, especially if you don't have experience with these types of valuation exercises. So I definitely want to help guide you through any problem areas you have on that exercise. I tried to design the problem to be as realistic as possible. I've also posted the valuation problem of the problem sets on my courses as well. I'm making that assignment due on June 5. I think that's Friday, June 5 at the end of the day as well. I know I've been told that you guys have a pretty hectic week, I think, next week. So I figured I would give you guys a little bit longer to work on that assignment. Does that seem reasonable to folks? Or is there an alternative timeline that people would prefer for the valuation problem? Does June 5 seem sensible and doable?
What's the deadline for the group project?
What's the deadline for the group project? I'm going to make that the group project, which is not, maybe calling it a project is maybe a bit of an exaggeration, because I'm going to make it a relatively short thing, kind of similar in length to one of the problem set questions. But I'll make that due on June 12th, basically the same time that the take-home final is going to be due.
Sounds great.
Perfect. Any other questions about this stuff? I'll post the final project at the end of this week.
Could you just please post the syllabus on the my courses?
Oh, the syllabus isn't posted? Absolutely. I'll post it during the break at the middle of our lecture today. Sorry, I didn't realize that it wasn't posted there.
So June 12th is the final group project and the take-home exam as well?
That's right. Again, as I said, the final group project is going to be is not going to be very long, so it's not comparable to like a group. I don't envision it being even close to comparable to a group project that you guys would have as a final deliverable for the course in your other classes. It'll be relatively straightforward, where I give you guys kind of pretty good guidance on what to do in the project. It's just something where you guys are going to get to play with real world data. Sorry, was someone asking a question? I couldn't hear clearly. Okay, I guess we might as well continue with our material for the course. So the objective of this week's lecture is to cover the second broad approach that we use in finance for valuation, which is discounted cash flow, or NPV, net present value based valuation. So similar to what we did last week with comparables based valuation, we're first going to start by talking about the standard use of net present value in the context specifically of valuing companies. Hello, I think someone maybe has their mic turned on. Oh, Juan Carlos? Yeah, I can actually mute him. Okay. Okay, so sorry about that. So as I said, this week we'll cover DCF based valuation, and in terms of order of procedure for this week's lecture, we're first going to start with an overview of standard use of net present value, specifically for valuing companies. And then we'll discuss about the adjustments that we make to standard DCF approaches for valuation that are specifically relevant for the valuation of startups. And we'll develop two methods for adjusting DCF for use in the valuation of startups. The first is going to kind of combine DCF ideas with the VC method, which is related to something that we developed last week. So where we were taking exit value conditional on success divided by 1 plus a VC discount rate to the power of T, where D had given us some some good kind of average rule of thumb values to use depending on which stage of the life cycle your startup's at. So we're going to kind of develop one DCF based approach that's related to using that approach that we had used in our comparables based valuation last week. And then we'll develop a more fully fledged DCF valuation approach as well. And in our discussion of implementing standard DCF valuations for startups, we'll importantly kind of cover two sets of kind of rule of thumb approaches to getting key inputs for evaluation. One is going to be cash flow forecasting, specifically in the context of startups. We're always going to take a top-down approach to this cash flow forecasting. So where we're going to start with forecasts of an overall market size, apply market share forecasts. So basically try to guess like how much does our startup have in terms of market share in the future, and specifically we'll be focusing on what happens to a startup's market share over time if it proves to be successful. So we're going to be actually forecasting in the context of startups, cash flows conditional on success. And then we'll also talk about discount rates. So we'll talk both about discount rates, like how do you obtain a fair discount rate and how do you assess the amount of risk associated with a specific investment. And we're specifically going to discuss that within the context of the most common model that's used in finance for assessing the proper risk and return for an investment, which is going to be the capital asset pricing model. I'll actually first introduce this model in the context of our standard use of DCF, and then we'll talk about how we adjust our estimation of discount rates for startups, because for startups, we're going to take a bit of a different perspective to the way that we think about discount rates for mature companies. So in the standard use of DCF. So standard use of DCF, we typically assume that the discount rate is constant over time. That's an assumption that doesn't really make sense in the context of a startup, because a startup usually is far riskier early on than it is later on if it succeeds and stabilizes. So one additional thing that we're going to be discussing specifically in the context of startups that's usually ignored in standard use of DCF is this idea that there's a life cycle of discount rates, where discount rates start higher for startups, and then over time, as they kind of go into different phases of their life cycle, the discount rates start to decline. But in essence, basically today, our goal is cover standard use of DCF, discuss how we adjust standard DCF for startups, and then talk a little bit about how we actually implement our estimation of the key inputs in evaluation, with actually some of what we cover here being both relevant for standard DCF and for startups. In the context of our standard implementation of discounted cash flow valuation, I'm going to stick more to the mechanics of doing evaluation. And then in our discussion of applying DCF for startups, I'll talk a little bit more at length of how we get our key inputs for doing this valuation in the real world. So what type of data do we use, so on and so forth. All right, so let's go ahead and start discussing this material. So when we use DCF for valuing either a firm or a project, we want to obtain, right, two sets of key inputs in our standard use of DCF. One is a discount rate, right? And today is where I'm going to kind of discuss the model that we use for obtaining these discount rates. If you recall, we obviously used NPV in our unit economics calculations in an earlier lecture, but we didn't discuss where the discount rates came from. I just posited a specific discount rate to use. So one important deliverable about the first part of the course today is we'll discuss, you know, the main model that people in finance and practitioners use to assess what a fair discount rate for a project would be. And then in addition to that, when we're valuing a firm or a project, we need to get the cash flows associated with these with this firm or with this project. And given, you know, the combination of those two sets of forecasts, you know, the final step for doing evaluation is relatively straightforward. It's just kind of mathematically implementing the calculation that I illustrate in Formula 1 here. But the real challenge in these types of exercise is to, you know, obtain these forecasts of future expected cash flows and an estimate of what the fair discount rate for a project or for a firm should be. So again, today we're going to be focusing less on project. We're going to be focusing more on valuing a firm. So in terms of you know, the standard approach, what we're going to be basically doing in order to operationalize this NPV calculation is we're going to basically split these two sets of forecasts that we need into two steps. So first, I'm going to focus solely on how we obtain fair discount rates for a given firm if we were valuing a firm, and then we'll talk about how we forecast the expected future cash flows of a firm as well. One thing I should be clear about when we're talking about forecasting expected future cash flows when we do a standard use of DCF is what we're trying to do with future cash flows, because these future cash flows are uncertain, obviously. We're trying to figure out what the average future cash flow would be. So for instance, if we're getting cash flow at time 2 for a firm, what we want to try to figure out is, well, what are all the potential positive outcomes? What are the potential negative outcomes? And we want to basically take a probability weighted average of those things, right? So we're not when we're forecasting cash flows thinking about, well, what will cash flows be if things go well, right? We're specifically trying to map out, you know, what kind of, you know, take the expectation across all potential future scenarios. Yes, Devanshu, you have a question?
Kind of. I'm guessing, is this a typo that the denominator of CF1 should be 1 plus R to the power 1 and not 2?
Yeah, thank you very much. Yes, this is a typo. So apologies for this. The 2 here should be just a 1. Absolutely. So I apologize for that. I'll update the I'll try to remember to update the slide and get rid of this typo. I'm not really sure how this popped up here. But absolutely right. Yeah, we should be basically taking our cash flow 1 period, discounting it for 1 period, cash flow at time 2, discounting it by 2 periods, cash flow at time t, discounting it by t periods. Absolutely. So as I said, we'll cover the standard approach first. We'll split the standard approach into 2 steps. Step 1, getting discount rates. Step 2, getting mainly focusing on the mechanics of getting forecasted future cash flows. And then we'll do one exercise where we do both step 1 and step 2 and combine that into an NPV calculation. So that'll be basically the first part of today's lecture. And then in the second part of today's lecture, we'll focus on how to implement these valuations, specifically in the context of startups, given the types of data that we have available to us for startups. All right, so let's go ahead and tackle step 1 and step 2 in sequence. So the first thing we're going to discuss is how do we get a fair discount rate, right? The right, the fair expected rate of return for a risky investment on the part of an investor that might be investing in a specific firm. And so the model that we're going to use for getting the fair rate of return is going to build on something called the capital asset pricing model, or the CAPM for short. And so the CAPM is basically a mathematical model that provides a prediction on what the fair rate of return on investment is for an investor making a risky investment in financial markets. And I'm mainly just going to present the model. I'm not going to mathematically prove the model to you guys, but I'll give you guys the most important logic behind this model for discount rates. So what the CAPM says is, it says the expected return on a risky investment I is equal to the riskless rate. RF here is just my notation for the riskless rate, plus a risk premium. And the risk premium of an investment is investment specific, right? So different investments will have different risk premia, right? So let's say the riskless rate is 4% and the expected return on the asset, let's say an investment in the whole company, is 8%. Well, that would mean that the risk premium on this investment is 8% minus 4%, which is 4% as well. But what the CAPM does is it gives us a formula for what the fair risk premium is. And what the CAPM says is that the fair risk premium for a given asset is proportional to the risk premium on the overall market. So RM here is the return on something called the market portfolio. So this is kind of like a hypothetical portfolio that holds all tradable wealth in the economy, right? So think if you put all wealth, I mean, even more generally, if you put all wealth into one portfolio, what would be the return on that overall wealth portfolio? ERM just means the expected return on the overall market, right? And so ERM minus RF is what we call the market risk premium, right? So it's how much over the riskless rate does the overall market need to return. We usually proxy the market portfolio, so M, with some sort of broad-based equity index. So by far the most common proxy for the market portfolio is the S&P 500 index, or a global version of that market portfolio. And so what is the risk premium of a given investment I? It's measured by the product of the market risk premium and something called the market beta of investment I, right? So different investments will have different market betas, and market beta is given by the following formula. It's the covariance between the returns of investment I and the return on the market, scaled down, so divided by the variance on the market. Right? So the higher the covariance between the your investment I and that you're trying to value and the market portfolio, the higher the beta of this investment. And the higher the beta of the investment, the higher the market, the risk premium of investment I. So, and in particular, if you double the market beta of asset I, you're going to double its risk premium. I see a question from Kyle. What would an example of the riskless rate be? So the riskless rate, by far the most common riskless rate to use when you're using the CAPM to get an estimate of discount rates for an asset is a short-term U.S. government bond, so something called a U.S. Treasury bill. And among the different U.S. Treasury securities, the most common one to use to get this number is the 90-day, the promised yield on the most recent 90-day U.S. Treasury bill. So that's the most common number to use when you want to get a discount rate for valuing at least a U.S. company. If you're valuing a company that has cash flows that are not denominated in U.S. dollars, I don't want to get into the details of all this stuff because we don't have time to go over kind of international finance topics. But there's basically kind of two strategies that we can use for valuation when cash flows, right? So these cash flows are not in, say, U.S. dollars. We either want to convert our discount rate from a U.S. discount rate to a discount rate for the currency that our cash flows are in, or we want to convert our cash flows from that alternative currency to U.S. dollars, and that's done with a particular type of currency-related security called currency forwards. I don't really have time to go into those details. So for the purposes of today's class, we're going to be assuming, right, in terms of our discussion, when I'm thinking about forecasting cash flows, I'm forecasting them in U.S. dollars, and the guidance I'm giving you is really going to be about getting a U.S. discount rate. If you wanted to get, for instance, a Canadian discount rate, an alternative would be to take a short-term Canadian Canadian government bond, but then you would want to be a little bit careful about making adjustments to this. So normally we try to do things off of U.S. dollar forecast because it's usually easiest to get these discount rates denominated in U.S. dollars. Okay, so now the question is, what does this market beta represent? So the market beta here is really our measure of risk for a given security. And so what the CAPM is telling us is that the risk of a given investment is represented by basically how much that investment moves with the market, right? Because we know covariance between two random variables tells us, how much these two random variables move together. It also gives us a sense of, if one of the variables, how much it's going, what its value is going to be. It gives you an ability to predict what the value of the other random variable is going to be. But what does covariance between what does covariance between asset I and the market actually represent? So what this represents is the amount of non-diversifiable risk associated with investment I. So that's one of the key insights that we get in almost every model of discount rates in finance, including this landmark model, the CAPM. What these models all basically say is you can take the uncertainty of returns for a given asset, say asset I, and you can split it up into two parts. A part that's diversifiable and a part that's non-diversifiable. What does it mean for uncertainty to be diversifiable? It means if you hold a portfolio of risky investments, right? So you don't just hold an investment in asset I. Obviously, if you hold only asset I, none of its risk is diversified because by definition, you're bearing the entirety of the risk. But when you hold multiple assets together, some of the risk across different assets kind of dampen or cancel each other out. And that reduction in risk that comes from holding multiple assets instead of just one is called diversification, and it's called eliminating diversifiable risk. It turns out if all investors hold diversified portfolios, at least in the CAPM model, what that means is investors are going to end up holding market risk. And if all investors hold market risk because they optimally diversify, then in that scenario, how much an asset moves with the market tells you how much risk that asset exposes you to. Because any return of asset I that moves with the market is precisely risk that is not diversified away. Meanwhile, the component of returns that does not move with the market, when you hold a large portfolio of many diversified assets, that risk, which is called sometimes diversifiable risk, or it's called idiosyncratic risk as well, that risk vanishes. And what the CAPM says is you should only require a risk premium for the risk that you cannot diversify away, which is why this formula says, look, you need a baseline riskless rate of return. And for the risk that this asset exposes you to, you're given a risk premium, but that risk premium only rewards you for beta I, so only rewards you for the part of the uncertainty of asset I's return that moves with the market, because that's the risk that you cannot diversify away. So if you have an asset, for instance, that has zero covariance with the market, but has still some uncertainty, that asset isn't going to have a risk premium, because even though that asset has uncertain returns, you're able to almost entirely eliminate that risk when you hold that asset as only part of a broader portfolio that holds, again, as I said, many positions in different risky assets. Again, according to the CAPM, everyone would roughly hold market risk. Right, so this is the capital asset pricing model. It basically tells you, it basically gives you a model of how you can forecast the fair discount rate for a risky investment I. Now, generally, in order to be able to implement the CAPM, you need to be able to compute this covariance between asset I and the market. And so the way we estimate the market beta of asset I is using historical data on the returns of investments. Now, this is easiest to implement for publicly traded companies, right? So, and in fact, generally, this is the only set of companies that we can do these calculations for in a granular manner is publicly traded companies. And the most natural thing to do is to look at the equity of a given company. So if you've got a publicly traded company, you could collect historical data on the returns of that company, right? And then you would want to collect data on some proxy of the market portfolio, historical data on the market portfolio's returns. So for instance, you might look at the most common calculation to do for getting market betas for assets is to look at monthly returns going back 5 years. And so you could collect monthly returns on a given stock I over the past 5 years, calculate data on the returns to, say, the S&P 500 over those same 5 years as well. One way to get an estimate of the beta is just to compute sample covariance of those two historical series of data, and then just divide that by your sample variance for the market portfolio, so the S&P 500, for instance. Another way to get an estimate of this beta I is to run a regression where you use, RI is your Y variable, your historical data on S&P 500 returns is your X variable. and then this would be your slope coefficient from the regression. So those are the ways that we usually kind of get an estimate of these market betas for equity investments. Now you'll notice that I said, the most common calculation for estimating these betas is to go back 5 years monthly data. Generally when we think of statistics, we think of like more data being better. So there's a practical justification for why we usually don't calculate our betas off of more than 5 years worth of data, which is that when we do this calculation, we're assuming that the beta of an asset is constant over time. Now, in reality, we know that the market betas of stocks can change over time. So for instance, if a particular company acquires a new company that has a different level of risk than theirs, then we would expect the beta of that company's equity to change, for instance. Or if a company starts having more debt, we would expect that its equity would, because it becomes more levered equity, we would expect its beta of equity to increase. So there's a variety of reasons why we can expect these market betas to change over time. And since we don't want to develop a very complicated model that tries to model all the ways that a company's betas can change, we just try to use a sample of data where we think, over this horizon of time, the market beta, if it has changed, hasn't changed too much. So again, a common rule of thumb that's used is monthly data going back 5 years. If you're worried that a particular asset might have had changes in its betas, again, a good usual suspect for that is a major acquisition within the last 5 years, then you might want to pick even a shorter horizon. So another common rule of thumb that's used for estimating these market betas is to use weekly data instead of monthly data, and to extend that back something to the order of 2 years. But we usually don't estimate these betas off of more than 5 years worth of data, because this formula here is assuming that the beta is constant over time. And we're thinking kind of 8-10 years ago, we're less comfortable making the assumption that the beta hasn't changed over that horizon of time. But yeah, so this basically tells you how to get beta I. So if you want to get your beta I for a given, to get the discount rate that we should use for a given stock, then we would look at the historical returns of that stock, compute the covariance with the return on some proxy of the market, as I said, like the S&P 500, scale that by the variance of that market proxy, and that would give us our estimate of the market beta for that stock. And once we have that, we look at our riskless rate, which, as Kyle had asked, we would look at the riskless rate on short-term US government bonds. And then we take our market beta and multiply that by an estimate of the market risk premium. Estimate of market risk premium we'll often get by just computing the historical gap between the riskless rate and the expected return on our proxy of the market. And for that, we usually use data extending further back than 5 years. So while we estimate our beta I off of at most generally 5 years of data, our market risk premium, we usually draw our estimates using sample averages going back something to the order of 20 years. So looking over the last 20 years, what has been the extra return on an annual basis that the market portfolio, so say the S&P 500 is returned over and above the riskless rate, we would, again, maybe take annual data going back 20 years, average that. So that's a common estimate of the market risk premium. Another thing you can sometimes do for to get these estimates of the market risk premium is you can take surveys from experts, or again, some other estimates that are found in public domain that use kind of more sophisticated modeling for getting these market risk premia. So there's a variety of things. You can just build your own using 20 years historical data, or you can try to use, again, more sophisticated estimates from experts. Maybe I'll give you guys a source of commonly used sources for estimates on the market risk premium as well. The one thing I do want to point out is, let's say you want to get the discount rate for many different investments. So investment 1, 2, all the way up to 10. For the 10 investments, you would use the same riskless rate. You would use the same market premium. So those two numbers are constant across all risky investments. The only thing that'll change from investment to investment is the beta, which is specific to that investment. Right. So, once you've taken a stand on what the riskless rate is and what the market risk premium is, the only thing that's going to be changing from asset to asset is your estimate of market beta. Now, given what I've said so far, I've told us how to get market betas for equities. We can do something similar for publicly traded debt, right? So we could do something similar for corporate bonds, for instance. But what I haven't discussed here is how we would get a discount rate for the entire company, because the discount rate for an entire company is not the same as the discount rate of, say, a company's equity. And so what I have in my first formula in this slide here tells us how to go from estimates of the discount rate of, say, a company's equity and a company's debt, and how to use that information to get a discount rate for valuing the company as a whole. So this is something called the weighted average cost of capital. So what the weighted average cost of capital says is the fair discount rate, so the R that we want to use to value an entire company, should be equal to a weighted average of the after-tax cost of debt. So basically the, so if we, for instance, got an estimate of what the beta of debt would be by taking a look at a company's publicly traded debt and computing a market beta for that publicly traded debt, plugging that into the CAPM formula, that would give us an estimate of what the cost of debt for that company would be. We do the same thing for this company's equity, right? We look up its historical returns on its stock, covary that with the historical returns on the market, plug that into the CAPM, we would get expected return on the equity of the company. The fair rate of return on the company as a whole would basically look at the ratio between them on a market value basis, like what percentage of a company's market value comes from its debt versus what percentage of a company's value comes from its equity. So when I say company value, I, in this context here, specifically mean the sum of the market value of a company's debt and a company's equity. So the market value of equity is just number of shares outstanding times times price per share. Debt is ideally we would get a market value estimate of debt. In practice, we have to. It's more difficult to get an exact market value of debt estimate for a company, even one that's publicly traded, because not necessarily all of its debt is. In fact, for most companies, a reasonable fraction, if not most of its debt, is not publicly traded. So it might have bank debt and other forms of private debt. And so it's actually difficult to get a market value estimate of this debt. So the way we usually estimate this in practice is we look at the book value of debt associated with a company. And so given this information, we basically can figure out, well, what percentage of a company's value comes from its debt, what percentage of a company's value comes from its equity, and the fair rate of return on the company as a whole is just this portfolio, like it's just this percentage value weighted average of the fair rate of return on both types of investments, right? So if your company is 75% equity and 25% debt, then the overall fair return on the company, which in some sense is actually a portfolio that is 25% debt and 75% equity, the expected return on that portfolio should be 75% times the expected return of equity plus 25% times the expected return of debt. Now, one other thing that I'll mention about the expected return on the debt here. So you'll notice expected return on equity. I just took the expected return on equity. This number here, again, just to reiterate, would be obtained from the CAPM by computing the beta of this equity and just, you know, computing, you know, the CAPM implied value once you've taken a stand on what the market risk premium, the riskless rate is. But you'll notice that for debt, what I did is I took this expected return on debt, which I would obtain from the CAPM formula, but I adjusted that number by multiplying it by 1 minus tax, where tax is the tax rate that a company pays on its profits. The reason why my formula computes things a little bit differently for debt than for equity is related to basic tax fact, at least that applies for US companies, which is that any interest payment that a company makes on its debt is tax deductible. And so since interest payments on debt are tax deductible, one way to think about this is a company, when it issues debt, essentially doesn't pay the entire interest payment that it makes to its investors. So in particular, if a company pays, let's say a company has a tax rate of 30% and it pays $100 million in interest payments. Well, that $100 million in interest payments is going to lower its reported income by $100 million. And since it lowers its reported income by $100 million, it's going to lower its tax bill by 30 million, right? 30% of 100 million. And so that represents savings for the company. And so one way to think about this is for every dollar of interest that the company pays to its investors, and the CAPM is a statement about what investors require. So, right, so let's say we've got an ERD of 5%. What that would mean is investors who buy the debt of this company need to receive a 5% annual rate of return on their investment. But from the perspective of the company doesn't pay this full 5% because 30% of that 5% they get to use to reduce their tax burden. And so from the perspective of the company actually, when we factor in the tax benefit of debt, is actually only paying 70% of 5%, which would be 3.5%, right? So if a company was paying, you know, I don't remember the number. I'll use numbers that I can calculate in my head. So let's say a company is 50% debt, 50% equity, right? On 50% of its capital, it's paying an interest rate, you know, once we factor in the tax benefit of debt, of 3.5%. On the remaining 50%, let's say it's paying 8.5% as a cost of equity, right? So the fair rate of return on its equity. What would be the expected rate of return that it needs to give to investors when we weigh both the debt and the equity? It would be 50% of 3.5% plus 50% of 8.5%, which would be, in this case, 6%. And so that would be the discount rate that we would want to use for valuing the cash flows of the whole company. Right, so just to kind of summarize this in steps. So what we've discussed so far in terms of getting the discount rate of a company right? If that company is publicly traded, we use the CAPM to get that company's cost of equity by looking at the historical returns of that company's equity, the historical returns on the say S&P 500, computing our estimate of the beta of that company's equity. Once we have that, we plug into the CAPM. That gives us expected return on equity for this company using the CAPM. To get the cost of debt, if the company has publicly traded debt, we can also do the same calculation where we need to go get our historical returns on that company's corporate bonds. If the company doesn't have any corporate bonds, we usually look for that company's credit rating, and we look to see what the average rate of return for corporate bonds that have a similar credit rating to that company. There are other things we can do. We can look at like the amount of leverage that a company has. So we calculate D over V for the company and look, companies that have a similar value of D over V, what is their cost of debt? And then we estimate this cost of debt, scale it down by 1 minus tax rate to get the after-tax cost of debt. And then, as I said, take a weighted average using the percentage of the company that's debt versus percentage of the company that's equity to get an overall discount rate for the company as a whole. I see that I have a couple of questions here. So why was debt subject to tax? So I just, again, you can have variation from country to country. So this formula, let's be clear, this formula makes an assumption that interest payments on debt are tax deductible and interest payments on equity are not tax deductible. I'm not familiar with interest payments to equity being tax deductible anywhere in the world, but there can be some variation on whether interest payments on debt are tax deductible. So if interest payments on debt are not tax deductible, we would not want to multiply this by 1 minus tax. We would just take D over V times expected return on debt plus E over V times expected return on equity. And by the way, so current US tax code is that interest payments on debt are tax deductible, but that may not be true forever. So if the tax rule changes, the way we calculate the discount rate for the entire firm will change as well. But all I've said here is basically that the fair discount rate for the company as a whole should be the average of the part of the expected returns that the company pays, averaged out across all the different securities that it's issued, its debt and its equity. Okay, it says, so will the R change every year according to different tax brackets that the company falls into each year? So, in principle, if the corporate tax rate for a company changes, and it could change for a variety of reasons, it could change because of changes in a country's corporate tax code. It could change because of changes in a company's ability to manipulate its tax rate by, moving some of its profits offshore to tax havens and stuff like that. So to the extent that tax rates change over time, in theory, Juan Carlos, you're absolutely right, R would change. Typically, when we do these valuations, we assume a constant R over time. So we're abstracting away from, all these potential sources of changing discount rates over time. So in principle, we don't believe this to be perfectly true. So we don't believe that discount rates should be exactly constant over time, because they can change for a variety of reasons, right? So they could change because of changes in tax in the corporate tax code, but they could also change because the beta of a company's equity or a beta of a company's debt could change. They could also change because market risk premia change, right? So we could think like during periods of market turmoil, markets are more reluctant to invest in risky securities. And if they're more reluctant to invest in risky securities, we would expect that the risk premium for the market would go up, right? So all of these factors in theory can change over time. When it comes to doing an actual valuation in practice, almost always we model these as being constant over time. not because we think it's perfectly accurate, but because trying to model how all of these things are expected to change over time is not something that we can do in any and in any real precise manner. So we don't have good models that give us, again, like historically accurate estimates of how R might be changing over time. So we, at least for mature companies, tend to assume just a constant discount rate in our valuation. We're going to do it a little bit differently, as I said, in the context of startups. So in startups, we will have a changing discount rate over time, but it's not going to be because of changes in tax codes or anything like that. It'll just be because of predictable reductions in risk for a startup as it matures. But I'll get to the changing discount rate in the context of a startups in the second part of today's lecture. Another thing I should mention is what I've done so far is I've discussed how we could get the weighted average cost of capital for a company that's publicly traded, right? Because implementing the calculation that I just described, right? So calculating this by employing the CAPM is something that I've only described how to do for a company that's publicly traded. Now, there are a bunch of companies we might want to value that are not publicly traded. So what do we usually do for those companies? And so for those companies, what we generally try to do is we try to use a bit of the logic of comparables that we discussed last lecture, which is we try to find publicly traded companies that are similar to the private company that we're trying to value. And what we do is we calculate the this information for those public companies, and we make the assumption that, right, let's say we find 5 companies that we think are pretty comparable to the private company we want to value. We would then go and maybe estimate the weighted average cost of capital, right? So this number for each of the 5 public companies that we think are comparable to the private company we want to value, and we would just average out the WACs of those comparables to get our weighted average cost of capital of the company that we want to value that's not publicly traded. So this is the most standard thing to do when we're trying to value a company that isn't publicly traded, so that we can't do these calculations specifically for that company. As we find comparables, we do the calculations for the comparables, and we average out our calculation of Formula 2 here across all of our comparables. There's an alternative approach that's sometimes used as well, which is instead of taking the average of the weighted average cost of capital of each of the comparables, right? So where we do the following calculation, right? So first, we do this calculation for the debt and the equity of each comparable, plug them into the CAPM to get the expected return on equity and the expected return on debt for each of the comparables. And then for each company, we see what percentage of those comparable, of that comparable's value is debt versus equity, and then we do this WACC calculation. An alternative is to estimate something called the beta of assets of each comparable. So we take our estimate of the beta of equity of a given comparable. For that same comparable, we estimate the beta of debt for that comparable. And to get the beta of assets is kind of like the beta of the whole firm. To get the beta of the whole firm, we take D over V for that company, multiply that by the beta of debt of that company, plus E over V times the beta of equity of the company. So just like we did a weighted average using percentage of company that's debt, percentage of company that's equity in our formula for the weighted average cost of capital, we can do the same calculation for getting the beta of assets or the beta of the whole company. We just take beta of the whole company is equal to D over V times beta of debt plus E over V times beta of equity. And so we would calculate that beta of asset for comparable one all the way up to calculating the beta of asset of company N. And we would average that out. That would give us our estimate of the beta of assets or the beta of the company for the company that we want to value. And then what we would do is we would plug in that beta of asset into the CAPM formula. So we plug in beta of asset into here. And that would give us an expected return. Right? So this number here is obtained by plugging beta asset into the CAPM formula. Now, when we do that, effectively, we're assuming that a company has no debt or it gets no tax benefits from debt. And so we'd have to take this number that we obtained, again, by taking the average of the beta of assets of comparables, plugging that into the CAPM formula, and we'd have to subtract the tax benefits associated with the company we're valuing actually issuing debt. So we would take the D over V for the company we want to value, and we would multiply it by that company's cost of debt, or an estimate of what that company's cost of debt would be, and that company's tax rate. So this is an alternative approach. Just in terms of noting the difference between approach 1 and approach 2. Approach 1, people generally find it easier to calculate. It's also the one that by far is used more often. Approach 2 can be theoretically more accurate than approach 1 in one very specific scenario, which is if the company you're valuing has a very different level of leverage than the comparables, then you may want to use approach 2 instead of approach 1. It's likely to be a more theoretically accurate calculation. But if your company's leverage is similar to the leverage of each of your comps, just do calculation 1, and it's going to be.
Professor, I just have a question on that.
Sure.
topic.
Yeah.
So
John.
if the amount of leverage for the company you're trying to value is much different than the comparables, if you wanted to, let's just assume you wanted to go with approach 1, couldn't you just calculate the required return on equity and debt for each of the comparables and just plug in the same D to V ratio of the company you're interested in valuing to calculate the WACC for each comparable using the same leverage ratio for the company you're interested in?
Yeah, so kind of theoretically, that's not an appropriate calculation, because when you want to get the WACC for a given company, you need to, like, all the inputs that you're putting into this formula here have to be specifically for that company. So you have to be putting in the leverage of that company. Like, if you want to get the discount rate for company 1, you need to be plugging in the leverage of company 1, not your company. The percentage of company 1's value that is equity times the cost of equity. The reason why you have to be plugging in that company's by the way, just for folks who are not familiar with terminology here, D divided by V is sometimes referred to as the leverage of a company. Leverage being like how much debt does a company use. The higher D over V, the more debt a company uses. You want to be putting in the numbers for that specific. The reason is, so let's say the comparable you're using is let's say 50% debt, 50% equity. And you were looking at, and your company is, let's say, 75% debt and 25% equity. So what Jonathan proposes, well, why don't we just put in 75% and 25%, because that's what our company has as leverage. The problem is theoretically, if the comparable that was 50-50, if they moved from 50-50 to 75-25, then both their cost of debt and their cost of equity would change, right? So let's say at 50-50, the comparable has a cost of equity, for instance, of 10%. Well, if all of a sudden the company made a change to its debt and equity composition and basically bought back a bunch of its equity and financed that repurchase by issuing a bunch of debt so that it would drive up its percentage of the company that's debt up to 75%, and it would drive down its percentage of company value that's equity down to 25%, well, that would actually make that company's equity substantially riskier, right? Because if a company has 75% debt, there's a higher likelihood that it goes bankrupt, for instance, right? But in addition to that, right, debt is a safer instrument than equity. And so if you shift up to 75% debt, the residual risk of the company is concentrated in the company's equity. Since it, the amount of equity that the company has is smaller, that basically means you're taking the same amount of uncertainty, but you're spreading it on a thinner base because you've got less equity in the company. That's going to make the risk of that equity go up.
But isn't I agree, like taking on more debt increases the risk profile of your company, right? Changing your balance sheet like that. But
Exactly.
Aren't those differentiated costs of debt, aren't they all baked into the asset beta anyway?
So absolutely, right. So they're going to be in the asset beta, but if I understood correctly, what you were saying is use your own company's D over V and use the other, like for every comparable.
Yeah.
And then use this.
That is what I was saying.
Yeah. So in some sense, when you do that calculation, you're actually effectively changing the beta of asset of each of those comparables, right? Because you're saying like, okay, you've got, let's say one way to think about it is if you calculated a similar calculation in the context of beta of assets would be to say, to calculate beta of asset of comparable one, take the D over V of your company times the beta of debt of company one plus E over V of your company times the beta of equity of company one. Well, that would actually not be the beta of assets of company one because you'd be you'd be assuming that the company is a different percentage debt and equity than it actually is. Definitely without a doubt, like if you do the WACC calculations, always use the D over V's of the correct comparables. If your leverage level is very different from that of the comparables, so isn't in the range of the leverages of the comparables, what I would do is calculate the beta of asset of your company by just taking the average of the beta of assets of each of the comps, where to get the beta of assets for each of the comps, you use the D over V and the E over V for each respective comp when getting its beta of assets. And then I would make the adjustment for your own company's leverage by making, again, taking CAPM value with this beta of asset and subtracting manually subtracting out the tax advantage that you have with your own issuance of debt using your own company's leverage here. If you try to do it directly by doing these calculations here, it's basically something called the leverage effect, right? So when you change a company's, like if a company changes its leverage, it's going to change both its cost of debt and more dramatically its cost of equity. And so by plugging in a different company's leverage to get another company's WACC, you're ignoring that leverage effect.
Okay, thank you.
No problem. Did you, Juan Carlos, you have a question?
Yeah, so this new formula is considering D over V, but the mix of debt and equity is going to change over time. So is it a good idea to use D over V for a startup?
Okay, so absolutely. These are like assuming a constant R and taking, because the numbers that we use for these D over V's and E over V's, we get these numbers by just looking at current values, right? So we would look up current book value of debt for a company, current market cap of a company, V is just the sum of the two, right? So we look at current numbers to assess what these ratios are. You're absolutely right. For some companies, and in particular for startups, we expect those numbers to change over time. So definitely, I would say we don't want to assume a constant discount rate for startups. But if you don't mind, like, we'll just defer that discussion of like how we would obtain discount rates for startups and model how those discount rates change over time. We'll defer to that discussion to when we talk about adjusting NPV for startups, or adjusting DCF. So right now we're just focusing on the standard procedure that we use in practice for valuing more mature companies, where we don't expect the leverage to be changing as much as we expect it to change for a startup, right? So most startups have little to no debt, right? So they're mostly equity financed early on. So we generally expect leverage of startups to increase over time.
Okay, thanks.
All right, so that's what I wanted to discuss for discount rates. I'm going to apply all of these calculations in the context of an example shortly, but before we start doing calculations, I'll first discuss the mechanics of forecasting cash flows as well. So, right, because obviously in addition to getting estimates of discount rates, we need to get estimates of cash flow forecasts. And right now I'm just going to be focusing on the mechanics of cash flow forecasting. So in particular, sorry, I'm just having some issues here with my, so now what I want to do is I want to kind of discuss how we can get forecasts of the cash flows associated with a firm or a project. So here we'll specifically be talking about things in the context of a firm. And I'm going to assume that we already have forecasts on the basic economics of a business. So I'm going to assume we already have, that we've done the research we need to be able to forecast out what the expected future revenues, expenses, capital expenditures, so on and so forth associated with a business are. And I'm going to give us a formula for, off of those forecasts, obtaining estimates of specifically the operating cash flows of a business. So the operating cash, right, because it's these estimates of cash flows that we need in order to get an estimate of the value of a project or company. So we'll be focusing on getting estimates of operating cash flows. One thing I should mention is when we think about the cash flows of a business, sometimes we think about operating cash flows, and at other times we might also think about just the overall cash flows of a business, which are different, right? Because they might also include the cash flows associated with investment activities and with like financing cash flows. So when you raise capital, or when you pay back dividends, those are also cash flows, or make interest payments, those are cash flows as well. We're going to focus specifically on forecasting operating cash flows and doing an NPV of those operating cash flows. We generally focus specifically on operating cash flows when we value companies in practice, because we generally think that all the other sources of cash flows, so for instance, financing cash flows, the NPV of those cash flows should be close to zero. The reason for that is, let's say I raise capital today. So I raise $1 billion by issuing some sort of security. And eventually that security is going to generate negative financing cash flows in the future as I repay the investor who purchased the security that I sold today. Well, if they get a fair rate of return on average on those investments, then the value of what they receive should be equal to the value of what they receive in the future should be equal to the value of what I receive today. So we generally think the NPV of non-operating cash flows is zero. And so because of that, if we want to value the whole company, the value of the whole company should be the NPV of its operations plus the NPV of its non-operating assets. But if the NPV of its non-operating cash flows is zero, then just focusing on the NPV of the operating cash flows is going to give us the correct value for this project or for the firm. So that's why we're going to focus specifically on operating cash flows here. And so the way that I like to think about operating cash flows is that cash flow expected at time t, we can think of cash flows as coming from a few different sources. There's kind of some, loosely speaking, kind of accounting measure of profits, right? So we could, one way to get operating cash flows at time t is to take 1 minus our tax rate times EBITDA, so earnings before interest, tax, depreciation, amortization. Loosely speaking, this number here, we can just think of it as being operating revenue minus operating expenses. And so we could think of 1 minus tax times operating revenue minus operating expenses as being an accounting measure of profits. But we need to make adjustments to this accounting measure of profits to get true cash flows, because we know accounting numbers don't necessarily recognize revenues and all expenses exactly at the time that they are received or paid. And so we need to think about, well, what is left out from this measure of accounting numbers, operating revenue minus operating expenses, that we need to factor in to figure out exactly when cash enters and leaves the company. So as I said, this is operating revenue minus operating expenses. Well, operating expenses don't pick up all the expenses associated with the business. So in particular, they leave out capital expenditures that are made by a company. So in order to get the true correct cash flow, we need to include this capital expenditure as a cash outflow. Well, if it's a purchase of an asset, we need to subtract that as a cash outflow for the company, because you're obviously paying for that asset, right? So if we look at this formula, the reason why we're making an adjustment to this accounting number, one reason is for capital expenditures. So in particular, on any date where we have a capital expenditure being made, say a capital expenditure in 1 year, what do we forecast that number to be? We need to subtract that from our forecast of what our cash flow at time 1 would be as well. But this isn't the only adjustment that we need to make to our accounting measures of profits that result from capital expenditures. Because just because capital expenditures don't show up in operating revenue doesn't mean that they get fully ignored in accounting numbers. In accounting numbers, they get recognized rather than immediately when the purchase is made. They get recognized slowly over time through depreciation, right? And so we know depreciation actually reduces your tax burden because this is earnings before interest, tax, and depreciation. This number here, I call it accounting, but it's accounting, numbers that are ignoring depreciation. And so what is the impact of depreciation on our cash flows? Well, depreciation itself is not a cash outflow, but because it lowers our reported income, it generates tax savings, and it generates tax savings that are not incorporated in this number here. So we need to add back in any tax savings that we get as a result of depreciation, right? So the two adjustments that I have in this formula here are making basically two adjustments. They're subtracting at time t. They're getting expected cash flow at time t by subtracting expected CapEx at time t due to capital expenditures at that point in time. And they're adding back in tax times whatever depreciation we forecast to be making at time t, which would be a recognition of expenses, from asset purchases that were made prior to time t, at time t. Right, so these two adjustments here are picking up the fact that this measure of accounting profits is not is not incorporating any considerations for capital expenditures and depreciation. And then there's a final adjustment that we need to make to get our cash flows at time t, which is an adjustment for something called working capital over time. Working capital over time is defined as, so working capital at time t is equal to accounts receivable at time t plus inventory at time t minus accounts payable at time t. And this like little triangle symbol times, triangle of working capital at time t. This just means change in working capital between time t minus 1 and time t. Now, the reason why we make this adjustment has to do with the way that operating revenue and operating expenses are recognized for taxation purposes, at least in the US tax code. So in particular, revenue for accounting purposes is recognized when a transaction is agreed upon as opposed to when it's paid, right? So if I sold, some widget to a customer today for $1,000, but they didn't pay me right away, I would still recognize that revenue of $1,000. But what would happen is I haven't received that $1,000. I would receive it hopefully in the future because I'm basically effectively extending credit to this customer. And when I'm extending credit to customer, I keep track of the total credit that I've extended to customers through something called accounts receivable, right? So what would happen is when I sold this widget to the customer, I would recognize operating revenues of $1,000. That would make this number go up, but actually it was not cash inflow into my company, right? So I would actually recognize an increase in cash flows. I would need to offset that improperly recognized cash flow by subtracting it out elsewhere. Well, this change in working capital is going to subtract out the fact that $1,000 of these operating revenues were not actually paid by doing what? By subtracting the increase in the accounts receivable that are going to occur because of this transaction, right? Because when I sell the asset, if I haven't received payment for the widget, my accounts receivable will go up by exactly the amount that I sold the widget for, right? So when you're extending credit to your customer, it increases your operating revenue, which is going to increase your tax burden, but you're going to eliminate the fact that you have operating revenue here that didn't actually come into the company by subtracting out the increase in the accounts receivable that occur from having extended credit to the customer. By the way, if your accounts receivable are falling, it's going to increase your cash flows because then you're going to be receiving money from customers that you don't need to classify as operating revenue because you recognize that revenue at some point in the past, but it's going to generate a cash inflow in the company, right? So if accounts receivable fall, then working capital is going to be negative. So you're going to be, the change in accounts receivable is going to be negative, which, subtract a negative of a negative is going to give you a positive increase. But in any case, the reason why we make this accounts receivable adjustment is because when you sell to customers on credit, you recognize the operating revenue, but it's not actually a cash inflow. So to get the exact precise timing of your cash flow, you need to subtract out that increase in accounts receivable. Similarly, we keep track of inventory because when we look at operating expenses in EBITDA, again, that's what we're going to be paying taxes on. The way we report our expenses or our operating expenses is through costs of goods sold, meaning that we only recognize our costs associated with producing a good when we sell the good, Meanwhile, we actually pay for the goods, not, right? We pay for the cost of the goods, not at the time of sale, but at the, say, at the time of actual production. So to the extent that we hold on to inventory, we recognize our costs later sometimes than when we actually paid for those goods. What inventory does is it keeps track of the costs that we've paid that we haven't recognized in our cost of goods sold yet. So if we're building up inventory, well, building up inventory is going to generate a negative cash outflow, but it's not going to be recognized in this calculation. So we need to subtract that cash outflow ourselves. The way we do that is by subtracting the increase in inventory manually. So that's why we include inventory within working capital. And then the final adjustment that we make is accounts payable, which is just the flip side of accounts receivable. Accounts receivable is credit that we extend to our customers. Accounts payable is credit that our suppliers extend to us. And so if we think about the effect of accounts payable on cash flows, right? Let's say we sell some products where we have not yet actually paid our suppliers for that product. Well, in that case, we would recognize the cost of goods sold, right? So we would recognize the cost in our EBITDA calculation, even though we haven't paid that cost yet. And so this cash flow number would be too low because we're recognizing some costs before we actually pay them. How do we adjust for that? By basically, right, how would this impact accounts payable, right? We're recognizing costs before we pay them. Well, that means that we owe more to our suppliers. So our accounts payable would go up. If our accounts payable go up, right, because this is a minus sign instead of a plus, our working capital would go down. If our working capital goes down, our cash flow would go up, thus reflecting the fact that we haven't paid all of the cost of goods sold that we're recognizing here because we haven't paid for some of the cost to suppliers for the goods that we've sold at this point. So that's why we make these three adjustments for working capital. So hopefully that provides some guidance on why accounts receivable, inventory, and accounts payable lead to the need to make additional adjustments in our cash flow formula. So what I'll do now is, I think kind of best thing to do at this point is just to do an example where we do both this kind of mechanics of cash flow forecasting and we calculate our discount rate. So I'm just going to present an example next. It's going to be more valuing a project than a firm. We'll talk about valuing the example of valuing a firm when we're discussing the context of startups. But in terms of the formulas and the mechanics of what we're doing, we basically do the same thing both for valuing a firm and valuing a specific project. But so let's take this specific hypothetical example. So we've got a company, Barton Mogul. I'll just refer to it as BM going forward. And let's assume that BM is planning to enter the online book selling business. Doing so, the company expects will require $50 million in upfront investments. So I'll classify all these upfront investments as capital expenditures, which are split equally between now, so time 0, and next year, time 1. So you'll notice in this problem, I'm taking a lot of forecasts as given, and I'm really just focusing for now on the mechanics of doing the valuation once we have these forecasts. We'll talk in the context, as I said, of valuing companies, how we usually come up with these forecasts in practice. But for now, let's just take these kind of the forecasts of the underlying economics of a project as given. So 50 million split as 25 times 0, 25 at time 1. These costs entirely fall under CapEx and will be depreciated over 5 years. from time 2 to time 6, so 2, 3, 4, 5, 6. And these assets are going to be sold for $20 million, we'll assume, at time t equals 11. Time here is in years. Following this setup period, the company is expected to have yearly operational expenses that will start at $20 million at time 2, and those are going to rise by 10% per year for the next 8 years. So we're assuming it's a project that lasts until time 10. Meanwhile, operating revenues are going to start at $17.5 million, also at time 2, and are going to rise by 30% per year for the next 8 years until t equals 10. After this period, everyone will be, well, okay, so after this period, we're just assuming that the project ends. Inventory and accounts receivable are forecasted to equal 7% and 3% of revenues, respectively. And I'm not mentioning anything about accounts payable here, so we'll just assume there are no accounts payable in this specific exercise. In addition to that, we're told that there's a corporate tax rate of 35%. So this information, along with the first 2 paragraphs, are going to give us everything we need to forecast out the operating cash flows of this project. We also need to have the information necessary to get the discount rate for this project. So I'm not sure if I give information. Yeah, I don't. So I don't directly. So you could either think of this as an example where Barton Mogul is not publicly traded, but even if Barton Mogul was publicly traded, Barton Mogul is right. This project that that Barton Mogul is thinking of undertaking is essentially an e-commerce project, and I'm assuming that Barton Mogul's other lines of business, or its predominant lines of business, are not e-commerce. So you would, even if Barton Mogul was a publicly traded company, you wouldn't want to use Barton Mogul's own discount rate or own weighted average cost of capital to value this project, because this project would be an atypical project for this company. Right. So that's actually another question you always want to ask yourself, even if you're so this is for a project as opposed to valuing a firm, is if you're valuing a project for a company that is atypical for this company, right? So it's in a different industry or a different stage of mature, like the specific sub-market that this project is entering is systematically a less mature subsegment of the sub-market than the other stuff that the company does, then in those cases, you don't want to use the company's own weighted average cost of capital to value this project. What you want to do is you want to find companies who are more similar, like publicly traded companies whose lines of business are more similar to your project than your own company. So in this particular context, I'll assume that the 2 best comparables for Barton Mogul are Amazon and Barnes and Noble. So, and in particular, I'll assume we've basically calculated, I'm going to assume we've calculated the beta of equity and the beta of debt using historical data for Amazon and Barnes and Noble already. So I'll assume that Amazon and Barnes and Noble, we estimated their covariance with the S&P 500 for both. And for both companies, we found an equity beta of 1.5. But we'll assume 30% of Amazon's firm value comes from debt, while 45% of Barnes and Noble's firm value comes from debt. So the D over V for Amazon is 0.3, and the D over V for Barnes and Noble is 0.45. So by the way, when you pick multiple comparables, the likelihood that they have the same beta of equity is essentially 0, right? So this is just a coincidence that I'm assuming they're the same for the two companies. So don't take this as being a general pattern. This is highly unusual. I'm also going to assume that both Amazon and Barnes and Noble have debt betas of 0. I'll assume a riskless rate of 5% and an expected return on the market portfolio of 15%. By the way, these numbers are not meant to be realistic, so we don't expect a 15% rate of return on the market portfolio. It's substantially less than that. But for the purposes of illustration and mechanics, these are the numbers I'll be using for now. All of these rates are expressed as effective annual rates. That means these are annual rates that we can use for valuing annual cash flows. And I'm going to assume that Barton Mogul has a debt to value ratio of 0.4, right? So notice 0.4 is similar to the average of the leverage of the comparables. So because of that, in practice, we feel very comfortable using approach 1 for getting weighted average cost of capital off of comparables by just averaging the WACC of the comparables. But I'm going to do both the calculation for approach 1 and approach 2 in my illustration right now. And we've got a beta of debt for Barton Mogul of 0.05, I'll assume. So given this information, we can both get our discount rate and our forecasted cash flows. So let's go ahead and do that. I'll do it step by step. So first I'll get the discount rates, and then I'll get the forecasted cash flows. Then we'll tie it all together to get an NPV for this specific project. So both steps, get the discount rate, get forecasted cash flows, and get the NPV. All of these things are found on an Excel spreadsheet called dcf.xls that I posted on my courses. So we'll do one step at a time. So first thing we'll do is we'll get our discount rate. So as I had stated in the problem, Amazon has a D over V of 0.3, has a beta of debt of 0. E over V is always just 1 minus D over V, right? Because the company is a mix of debt and equity. So anything that's not debt is equity, right? So if you're 30% debt, you'll be 70% equity. The beta of equity for Amazon is 1.5. We assume the tax rate in the problem of 35%, a riskless rate of 5%, and a market premium of 10%, which was the expected return on the market minus the riskless rate, right? So the market portfolio generates an extra 10% return relative to the riskless rate. So these are the basic inputs that we were given for Amazon. So we can go off of this information and calculate a WACC, a weighted average cost of capital for Amazon. Again, the steps that we undertake is we first calculate a cost of debt and a cost of equity for Amazon using the CAPM formula. So all I'm doing here is using the CAPM formula, right? CAPM formula says that the Amazon's debt should have a discount rate equal to the riskless rate plus a risk premium, where the risk premium is the beta of debt times the market risk premium. Now, of course, the beta of debt here is 0. So there's, something that has a beta of debt of 0 is going to have no market premium. So that just means, the pre-tax cost of debt is 5%. What about equity? We use the CAPM formula, but instead of using the beta of debt, we now use Amazon's beta of equity. So riskless rate, 5% plus beta of Amazon's equity, 1.5 times market premium, which is 10%. That gives us 20%. So a 15% risk premium on annual risk premium on Amazon's equity. So given these two numbers, we can now calculate the weighted average cost of capital, right? It was what? It was percentage of the company that's debt, 30%, times the after-tax cost of debt, which was 5%, times 1 minus 35%. So it's 65% of the 5% because Amazon doesn't need to pay the whole 5% to debt holders. They effectively save 35% of that because they get to recognize these interest payments on their income. So it's tax deductible. It reduces the net payment once we take into account the tax benefits that that the firm needs to pay to investors. So D over V times pre-tax cost of debt, which comes from the CAPAB, times 1 minus tax rate, plus E over V, so 70%, times cost of equity, 20%, which we had obtained from the CAPAB. That tells us Amazon has a weighted average cost of capital. Our estimate of that is a shade under 15%. By the way, when we do these calculations in practice, obviously, we're getting estimates of what the fair discount rate are because we don't have perfect calculations for a lot of the inputs in this model, right? So the market risk premium, we're estimating it off of historical data on the expected return on our proxy for the market portfolio. Our beta of debt and our beta of equity are going to be estimated off of historical samples of returns, say on equity and returns on, say, the S&P 500. So none of these things are estimated perfectly. So we should keep in mind that there's estimation error in these calculations. That's one of the reasons why we like to use multiple comparables if we can, because it allows us to kind of, if there's estimation error in each of these weighted average costs of capital, to the extent that those estimation errors aren't perfectly correlated with each other, we lower the noise or the potential mismeasurement in these estimates by computing these numbers for multiple comparables instead of just one. So for Barnes and Noble, we do the exact same calculation. So there's nothing different in the steps I did. So so just like before, step one, get your pre-tax cost of debt, get your cost of equity, and then do your weighted average cost of calculation. So what we did for Barnes and Noble is the same as what we did for Amazon. We just made sure that we used every step of the way the Barnes and Noble numbers to get the Barnes and Noble WACC, and the Amazon numbers to get the Amazon WACC. In addition to, so if we wanted to do approach one for, so let's see, approach, where are my slides here? So in approach one, we just calculated this number for Amazon. We calculated it for Barnes and Noble. We just take the average of the two numbers, So if I just take average of this and this, one estimate of the weighted average cost of capital, or the fair discount rate to use for valuing Barton Mogul, is about 13.7%. If we wanted to use the second approach, second approach, we would first calculate the beta of assets for Amazon, So we would use the D over V for Amazon times beta D plus E over V for Amazon times beta equity. That tells us the beta of assets for Amazon is about 1.05. Beta of assets similarly for Barnes and Noble is 0.825. So then we would, in approach two, calculate the average beta of assets for Barton Mogul using the average of the beta of assets of our comparables. So that would give us a beta of assets of about 0.94. D over V for Barton Mogul of 0.4 was given in the problem. And then what I've done here, maybe it's helpful to put an extra set of brackets here. So what I've put in brackets here, that's just CAPM formula using the beta of assets for Barton Mogul. So 5% riskless rate plus the beta of the entire Barton Mogul company, which is 0.94 times the market premium of 10%. So this was just CAPM. So what I have in brackets here, going back to my slides, is this number here. So this number here is just the value of the CAPM formula using the beta of assets that you first calculate. And then what I did is I subtracted out the reduction in discount rate that comes from Barton Mogul's use of debt. And so the company is 40% debt. So you take D over V for Barton Mogul specifically, times Barton Mogul's tax rate, times 5% riskless rate plus this 5% is something different. It was the beta of debt for Barton Mogul times 10% the market premium. And so that's how we get our second estimate, which is 13.6%. So you'll notice these two numbers are extremely similar. The reason why they're extremely similar is that the D over V for Barton Mogul was very close to the average of the D over V of Amazon and Barton Mogul. In fact, if it was exactly, that's not exactly true. So if it was exactly the same as the D over V, the average of the D over V for Amazon and Barton Mogul, and the beta of debt for Barton Mogul was the same as the beta of debt for Amazon and Barnes & Noble, then these two numbers would be exactly the same. But the fact that, again, 40% is pretty similar to the 30 and 45% respectively, gets us very similar estimates. Again, this just kind of highlights the fact that if your leverage is similar to the leverage of your comparables, you can just go and use approach one. It's really only in the cases where your company has an outlier level of leverage, either much lower, substantially lower, or substantially higher than your comps, that you might want to think of using approach two. Again, I will highlight that in practice, when practitioners do valuations, they almost always use approach one. So I did see that I got another question here. So would you need a return greater than the WACC to be making a profit? So exactly. So Kyle's question is if you want to think about whether an investment, so like whether Barton Mogul should undertake this project or not, they should undertake this project if they get greater than or equal to a fair return on the investment in this project. And the WACC exactly measures that. So weighted average cost of capital is telling you what a fair rate of return on the project is. And if you do an NPV with your WACC and you get an answer that's greater than 0, what that means is this project generates an average rate of return that is greater than WACC. And as a result, creates value for your company. So that's exactly correct, Kyle. So in any case, this is our mechanics of calculating weighted average cost of capital for a company, where we specifically did this, got the cost of the discount rate for this project using comparables. And we want to be comfortable getting discount rates from comparables, especially with startups, because obviously for a startup, it's not a publicly traded company. So we need to use comparables to try to get some insight on what the fair discount rate for a startup would be. So now let's go on to the next part of the exercise, which is that we want to use the cash flow formula to get our forecast of cash flows for this project over time. So I have that in my second sheet here. Just make this a little bit bigger. So one way that I like to organize things in a spreadsheet, for instance, when I do NPV calculations, either for a project or for valuing a firm as a whole, is I like to break my columns in a following very specific way. I have a column for time, right? So now in 1 year, all the way up to, we'll see, 11 years from now. And then I create the following sub-columns. I create a column for operating revenue, a column for operating expenses. Again, the forecast for operating revenue and operating expenses were given pretty clearly in the statement of the problem. We said that at time 2, which is time 2 is the first period that this project is actually operating. The first 2 periods, 0 and 1, are basically setup periods where we're making capital expenditures. 17.5 million, and it was growing at 30% per year. So I just grow this by 30% all the way up to time 10. I think I had said that the last period was time 10 for the project, right? So we're selling until time 10. Same thing for operating expenses. It was 20 million growing at 10% per year. So I just grow that at 10%. So one advantage of separating out operating revenues and operating expenses is oftentimes those two numbers are not necessarily going to grow at the same rate. So it's a lot easier to kind of break them up into sub-columns and then combine things into our first component of the cash flow equation, which was 1 minus tax times EBITDA, which was just operating revenue minus operating expenses. So 1 minus our tax rate times operating revenue minus operating expenses. So that gives us minus 1.625, and then can just use the same formula for every other entry in this column, right? So this is just combining the prior 2 columns information. So this is the first component. Again, there's judgment calls that need to be made to get operating revenue and operating expenses, where we're kind of taking those forecasts as given. I'll talk a little bit about how we might forecast those things in practice in the context of a startup in the next component of this lecture. Capital expenditures, we were told 50 million split equally at time 0 and time 1. So it's 25 million plus 25 million. But we were also told that there was a capital sale. So in particular, we were told that these assets would be sold for 20 million at time 11. So if we take a look at my capital expenditure column, you'll notice I have a minus 13 million. So a minus number represents a sale as opposed to an expenditure. So I like to put within the capital expenditure column also my capital sales, which get entered as negative numbers because they generate cash inflows instead of cash outflows. Why do I have minus 13 instead of minus 20? Because I am selling the asset for 20 million. It's because when I'm selling the asset at time 11, the asset has been fully depreciated because I stated in the problem, the asset is depreciated over 5 years from time 2 to time 6. So that means the asset is fully depreciated at time 6. And when an asset is fully depreciated, it's effectively what you've told the tax authority is this asset is worth nothing. If you sell the asset for more than nothing, you get a capital gain on your sale, and that you need to pay tax on as well. So what's happening in this column is I factored in the capital sale, right? A sale is a negative expenditure, so I put minus 20. But I need to pay tax of 35% on my capital gain. 20 minus 0. It's 0 because I'm assuming that I fully depreciated the asset by this date. And so I have to pay 7 million in taxes on my $20 million in proceeds from the sale. So that's where the minus 13 comes from. So just make sure if you've got a project where you expect there to be capital sales, make sure you include the proceeds and the tax implication from those sales in your cash flow forecast. Another type of thing you might see is in a project is if you're, for instance, if it's a project where you're updating an old manufacturing facility and you sell some of the assets in your old manufacturing facility, as part of your project, you would want to include the cash flow of your sale of the old assets in these early periods, right? So I have no asset sales happening at time one because this is just a brand new project. It's not a replacement of an old project. But sometimes you have both capital expenditures and capital sales in the early stages of a project. This is my column on depreciation. I'm assuming straight line depreciation so that we're depreciating in equal increments every period. Our $50 million in capital expenditures from times 0 and 1. So that means 50 million equal increments over 5 years is 10 per year, 10 million per year. So that's this column right here. In the real world, generally, we don't have straight line depreciation. We have very specific depreciation schedules for different categories of assets. So we could easily incorporate a different depreciation schedule into our forecasts here as well. Finally, the last kind of input component that we're going to have to get our cash flows is going to be working capital. As I said, working capital is always equal to what? It's accounts receivable plus inventory minus accounts payable. In this case here, I said that accounts receivable were 7% of operating revenue, and inventory was 3% of operating revenue. So that means, and I also said there was no accounts payable in this specific example. Let's say if accounts payable was, let's say 2% of operating expenses, then I would have added this to my expression to get my working capital. But again, in this problem, I don't have that, so I don't need to keep track of accounts payable. And so that means this gives us it's just formula style, always just 7% plus 3%, so 10% of operating revenue. And so this is a formula. I can just drag that down. That gives me working capital at each point in time. And from here, I can calculate my change in working capital, right? Because change in working capital is just working capital this period minus working capital last period. And then I can just drag that formula down. Just give me 1 second here. So this gives me my change in working capital, and the final step is just compute the cash flow formula, right? So just compute. I've got a column that's 1 minus tax times EBITDA. I've got a column that's depreciation. I've got a column that's CapEx, and I've got a column that's change in working capital. So I just take this column plus whatever my tax rate is, in this case 35%, times this column minus this column minus this column. And that just gives me my cash flow numbers. Right, so this plus 35% of this minus this minus this, and that gives me my cash flow numbers. So these are my cash flows, right? And I can get my NPV of the project by just basically using this forecasted cash flows along with my discount rate. I'll use the discount rate from approach 1, so cell B8. I've done it in one way in my spreadsheet where I've just kind of manually computed the present value of each individual cash flow. So I take cash flow at time 0 discounted for 0 periods, right? So discounted by 1 plus R, where R is obtained from B13 in the prior sheet, to the power of 0, which is just like not discounting. I do it this way, and this is why I have this column here, is I can just drag this formula down and it'll give me the present value of each individual cash flow. And then I can just sum up all of these present values to get my NPV. An even easier way to do this is to just use a function in Excel called NPV. And so we say NPV using discount rate. Now, when you use this NPV function, the only thing you want to make sure you remember is within this NPV function, highlight all your cash flows, but only starting at time 1. So don't include the time 0 cash flow. And then close your NPV function bracket, and then manually add your time 0 cash flow outside of the NPV function. It's just the way Excel chose to, or the developers of Excel chose to define the NPV function. The NPV function assumes that the first cash flow is at time 1, not at time 0. And so you need to manually add the time 0 cash flow in yourself. And that gives you the same answer. So 2 ways for you to do this calculation. By the way, one thing I'll mention is you'll notice this project has cash flows of 27 million at time 11, even though the project itself is only operating until time 10. The reason we've got cash flows at time 11 comes from 2 sources. One is the asset sale at time 11, right? We sell an asset for 20 million, but have to pay 7 million on that sale. That netted in 13 million. Another reason that we have cash flows, because obviously this number is bigger than just 13 million, is because working capital falls. So what's happening? So what does this negative number at time 11 represent? This minus 14 million represents the fact that, for instance, we have some sales that occurred at time 10 that weren't paid for right away. Remember, I said 7% of sales go into account payable. So what that means is 7% of our sales we recognize at time T, but they don't get paid until the next period. And so part of what's happening here is that some of our accounts payable from last period are getting paid from time 10, are being paid at time 11, and that represents cash inflows into the company. But so how do we interpret our eventual answer here? In this particular case here, we were evaluating a project. So the fact that this project has a positive NPV means that it adds value to the company. In particular, we're estimating that it adds about $28 million, right? And so what that means is relative to an investment that would deliver exactly the fair rate of return, so exactly an average return of equal to the WACC, this company is generating a higher return than that, and the net value as of today of those extra returns is about $29 million. So that's the way we interpret this. But this is basically the mechanics of a standard DCF. And what we'll do next is we'll talk about how we adjust standard DCF, specifically in the context of startups. So I think I'll take a little break for now before we move on to our application in the context of startups. But are there any questions about this example that we just did?
Professor?
Yeah?
Could you please do the Excel function NPV again?
Yeah.
Thank you.
So it's just first you do that discount rate, and then comma, you highlight your cash flows from time 1 to the end of the project. Close that, and then add this number. You get this.
Okay, perfect. Thanks.
The number is slightly different. It should actually be identical. So I'm just trying to see why that might be the case. Oh, B8, and then I did B13. Okay. So I did B13 in the, right. So in this calculation here, I used approach 2. So if I used approach 2 here, you'll see I get exactly the same answer. So 2865, 2865. So the reason I have a slight difference here is because I used, this is what I get with approach 1. This is what I get with approach 2. And indeed, consistent with what I said earlier, because the leverage of Barton Mogul was pretty similar to the average of the leverage of Amazon and Barnes and Noble, whether you use approach 1 or approach 2 doesn't make a quantitatively meaningful difference in our valuation of this project. Any other questions?
I have one.
Yeah.
I think, correct me if I'm wrong, but I'm not very sure. Was there a problem to use NPV when the cash flows are alternatively positive and negative?
That's an issue with a different metric for evaluating projects, which is IRR, so internal rate of return. So in fact, the reason why I focus on NPV is specifically because the conclusions that we get in terms of decide to invest or not invest based off of whether NPV is greater than 0 or not. It doesn't depend on whether you've got alternating cash flows, positive, negative, or whether they're all negative initially followed by all positive later on. Like, we don't need to consider those different scenarios when we do NPV, and we need to consider them more carefully when we use some of the other metrics that are occasionally used for evaluating projects. In the interest of time, we could only focus on one, but NPV is the most robust of the valuation approaches. It also has a clear interpretation, which is, what is this, how much value does this project add today, or how much is this investment worth to me today?
Okay, thanks.
No problem. All right, so I think I'll take, as I said, I'll take a little break here. So maybe we'll take, I guess as usual, a 20-minute break. So let's make the break till 7:30, let's say. Break till 7:30 p.m. So hopefully this gives us a chance to have a little breather before we go into the next part of today's lecture, which is, we'll talk about, as I said, adapting this approach to specifically to startups, which, among other things, kind of building on some questions that Juan Carlos had earlier, will involve thinking about how the discount rate for a startup would be expected to change over time. We're going to take a slightly different take also on cash flow forecasting based off of the type of data that we usually have that can be useful for forecasting for startups. All right, so yeah.